Hello everyone, welcome to the 21st episode of me learning how to trade using Forex. So in the last video we went through the support and resistance lessons in the technical analysis course on the official forex.com and we left off with trading with the trend. So yeah, let's get started on trading with the trend. So the trend is your friend. You'll often hear it said by traders, and for very good reason. Here we take a look at how trends work in technical analysis, how to identify them, and more. So trend is your friend. What is a trend? A trend is a term for when a given market is moving in one direction overall. A trend is the term for when a given market is moving in one direction overall. There are three directions in which a market can move: upwards, downwards, and sideways. A market can move in three directions: upwards, a bull run, downwards, a bear run, sideways. Range bound. Uptrend, downtrend, range bound. Yep. We've already covered the strategy of trend trading in the strategies and risk course, but whatever your chosen style, learning how to identify and classify trends as they form can go a long way of trading successfully. Trends come in three types. So, three types of trends: major or primary trend describes the dominant direction of a market's movement over a long period. The dominant direction of a market over a long period. From several months to several years. Intermediate or secondary trend occurs within major ones when the market moves in a certain direction over a shorter time. Trends occur OCC, you are within a major trend when a market moves in a certain direction over time, over a shorter time. Finally, minor trend will appear over a very short period, often less than a day. Will appear in over a very short period, often less than a day. Major, that's a big, oh, this is a pretty good die. Yoink this one. So we can see the overall as a major trend. That's the dominant trends. Intermediate, that's was it like over a short period? They said in a moves in a certain over a shorter period. So that's intermediate as well. That's intermediate, and then a minor would be very short. So a minor could be like that, there basically. Okay. So, for example, a market that has rallied significantly over the past 18 months is in a major uptrend. However, within that bull run, the market may become range bound for several weeks or months before resuming the rally. This would create an intermediate trend, and on any given day, a minor bull or bear run may form. The one thing I don't like is the fact that they keep calling it different things. So, if it's an uptrend, they'll call it a bull run, but I don't get why they just couldn't call it a major uptrend here as well, just to keep consistency, you know. But oh well. How to trade with trends. The type of trend you look to trade will depend on your chosen strategy. Long-term investors, such as position traders, look for primary trends. So, because that's the long term, isn't it? Long term investors, such as look for primary trends. That way they can capture larger moves to earn the larger profits required by their plan. Medium term traders, such as swing traders, may seek to capture secondary trends. Look for secondary trends. Long term, let's just call it traders. And then days to weeks. Day traders or scalpers, on the other hand, will only pay attention to minor trends. Short term traders, such as day traders, look for minor trends. Taking a contrarian view, you don't always have to trade with a prevailing trend. Indeed, lots of investors do the exact opposite. Instead of going with the general trend of the market, these contrarians take an opposing view, hoping to profit from an impending reversal. Whatever your approach to the markets, the difference between success and failure often depend on how well you can time your trends. If you can open positions as they form, then close before they reverse, then you'll soon see your profit margins grow. So whatever your approach to your markets, difference between success and failure will often depend on how well you can time your trends. Tools for trends. Technical analysts have lots of tools at their disposal for identifying and classifying trends. Trend lines. Trend lines are one of the simplest methods of determining bull and bear runs. The simplest. Of determining bull and bear runs. You apply them to charts, using them to identify the strength and direction of trends. Identify the strengths and direction of trends. Trend lines help to smooth out the oscillations within a market's price action, enabling to plot the rough course of any movement. They cut through the noise to show whether there is an underlying bull or bear run. Sideways trends, downtrend, uptrend, downtrend. Yep. You can spot an uptrend when there are higher highs and lower and when there are higher highs and lows as time passes. To apply a trend line on the chart that you believe is in a bull run, simply plot a line between 3 or more of the market's low points. 3 or more of the market's low points. When it has dropped to a low price and reversed, if the line points up, then you have confirmed the uptrend. The steeper the line, the stronger the move. So, plot a line between 3 or more of the market's low points. 1, 2, 3. Which, when it has dropped to a low price and reversed, if the line points up, then you have confirmed the uptrend. The steeper the line, the stronger the move. Yup. So, plot trend line between 3 or more of the market slows. And remember, the market slow point on our candle chart is this bit here, the wick. Downtrends, meanwhile, identified by ever lower highs and lows. Ever lower highs and lows. To find a downtrend, you draw a line between the 3 high points. If it points down, then the market's on a bear run. Yeah, I think that makes sense. While I can draw trend of 2 points, it isn't confirmed unless there are 3. True. Did you know a trend is always easier to see once it is established, so aiming to capture a move in its entirety is often unrealistic. Most traders aim to capture the majority of a trend rather than the exact top or bottom. Trend once established, though, aim to capture a move in its entirety is often aim to capture a majority of a trend rather than the exact top or bottom. Aim to capture a majority of a trend. If the lines are horizontal, then the market is range bound. When the market is sticking to its trend line, then you can use them as areas in which to open new positions, maximizing your profit within a trend. Channels. You can also use trend line to identify channels. Channels. Channels are comprised of 2 parallel lines. With a market's price action bouncing between them. With a market to find a channel, draw 2 trend lines, one between 2 high points on the chart and one between 2 low points on the chart. To find a channel, draw 2 trend lines, one between 2 high points on a chart, one between 2 low points on a chart. So one between 2 high points and one between 2 low points. Draw 2 trend lines, one between If the market's price action remains between these 2 lines, then you can trade the channel by selling at the top and buying at the bottom. You can use 2 parallel lines with the market's price action bouncing between them. So like that then, basically. Except it's like up or down. To find a channel, draw one between the 2 high points, one between the 2 low points. You can trade by selling. If the market's price action remains between these two lines, then you can trade the channel by selling at the top, buying at the bottom. If market's price action remains between these two lines, buy at the bottom and sell at the top. Patterns. Lots of traders will also use chart patterns to spot trends. When a market is in a trend, then its chart will typically show an ascending or descending staircase pattern. This is when each high or low outpaces the last. This is when each high or low outpaces the last. So this is when each high or low outpaces the last. So when that high is higher than that one, that high is higher than that one, and when that low is lower than that one, when that low is lower than that one. So spot trends. When market is in a trend, chart will show ascending or descending staircase. This is when each high or low outpaces the last. However, there are also lots of patterns that technical traders believe can predict whether a trend is about to form or reverse. These can include triangles, flags and wedges. We'll cover them in more detail in the next lesson. Volume. One useful tool when looking at trends is volume. Volume tells you how much a security has been traded in any given session, and can offer insight into how strong a move is. If a market is on the top but barely anyone is buying it, then the move may not have enough momentum to continue for much longer. Volume, so how many people are buying it basically. One useful tool. Check volume. For how much a asset has been traded in any given session. Can offer insight in how strong a move is. If the market is on the top but barely anyone is buying it, then the move may not have enough momentum to continue for much longer, so it's going to drop them basically. Indicators. Using indicators can also assist a trader in trading with the trend. A popular indicator used by traders is a moving average. This gives you an average of the market's price movements over a given period and can tell you when it's about to enter a new trend. The relative strength index, on the other hand, is often used to measure the strength of ongoing moves. Indicators and patterns can both be useful when looking at trading opportunities, but they aren't foolproof. Correct money management and risk control as always is imperative. Used to assist in trading with the trend. The relative strength index. Alright, so test your knowledge. Draw a trend line on this market. Which price levels would you use? What's that? 80, you wouldn't do that. What are the options? 120, 140, 160. Where's 120, 140, 160? 100, 130, and 160. 95. What's that? 90, 95, 130, and 175. I'll use that. No? Well, it depends where you want to draw it, isn't it? This is. Which price levels would you use? 120 is here, 140 or 160. So that has 20 between them, that's 30 between them. Let's go for the bigger one. Because then you get a wider spread, I guess. And this one has 45 between them. I guess that's too wide. Okay, it's a bit. To draw a trend line, which price levels would you use here? So the options given are 1,000. That's what's it? 50 between 50 each. That's 125, right? 125. That is 1370. That is 125. 125. That is 125 as well. They're both 125s. No, I must be tripping. Wait, 175. That is 125. That is 125. This one is 125. Oh wait, they must. Okay, I'm just tripping. All right. 130. Well, you start 1350. 1350. You wouldn't start here because that's nowhere near where the trend is. You do 1200. What is that? 1050. Do that right? Yeah. Just to get a general trend. Alright. Technical. Oh, charts and candlestick patterns. Let's examine how technical traders use the patterns created by the candlesticks on the chart to understand and predict market movements. What are patterns? Patterns are recognizable motifs created on the charts. So, recognizable motifs on a chart. Technical traders use them to quickly analyze market behavior and gain crucial insight into what might happen next, so they can trade accordingly. Used to gain, analyze market behavior and gain crucial insight into what might happen next. Technical analysis is based on the principle that chart patterns will repeat themselves, resulting in the same price action most of the time. But it won't always happen. But it won't happen all the time. So just got to be careful of that. Basically, say that 90% of the time in the past, a strong rally followed by a period of consolidation has led to a bear run. If a market rallies but then tapers off, a technical trader will see it as likely that another reversal may be on the cards. Right. Okay. Trading with patterns. While they can be useful predicting price action, when a pattern emerges, there's no guarantee of what will happen next, so most traders will wait to confirm their anticipated move, whether it's a new trend, reversal, or continuation before opening position. What this means in practice is that they'll wait for a few periods to check that the market is behaving the way they predicted, As ever, careful trading and strong risk management are also key. Right, patterns made of one or more candlesticks will offer a quick way of spotting to spot price action that offers a strong indication of a potential future move. Here are a few key examples. Candlestick patterns. Candlestick patterns are created by one or more individual sticks on a chart. One or more individual sticks on a chart. Doji. A doji pattern is formed when a market's opening and closing prices in a period are equal. Or very close to equal. So whatever happened within the candlestick itself, by the end of the session neither buyer nor sellers had the upper hand. So whatever happens within the candlestick itself, neither the sellers, by the end of the session neither the buyers or the sellers had the upper hand. So whatever happened between here so what neither buyers or the sellers had the upper hand. It is considered a neutral formation, suggesting indecision between bears and bulls. Neutral position. Between bears and bulls. Doji come in three main types: long leg, gravestone, and dragonfly. Doji. Go away. In a long leg doji, there was a significant amount of indecision as buyers and sellers took the market higher and lower before eventually cancelling each other out. Significant amount of indecision as buyers and sellers took the market higher and lower. So it goes boom, boom, and then back to here, boom. I can never spell that word. Indecision. As buyers and sellers took the market higher and lower before eventually cancelling each other out. Gravestone doji. Indicated that buyers initially pushed prices higher, so it goes boom, but sellers took back control and dubbed them back down again. Boom. The buyers, right? That buyers initially pushed the prices high, but sellers took back control and drove the prices down. The Dragonfly Doji. Sellers drove the market down, then buyers took over and brought it back up again. So opposite of what the gravestone is basically. Sellers drove the market back down. Prices down. But buyers took back control and brought it back up again. The doji is a single session pattern, which means that it is only comprised of one candlestick. However, they become much more useful when taken as a part of wider context. Gravestone doji, previous session. For example, a red gravestone doji after a long uptrend may be a sign that reversal is on the cards. Previous session. So that is basically it opens, because it's a green one, it opens at its lowest price and it closes at its highest price. Doji is single session pattern. Single session pattern. Single session pattern comprised of one candlestick. However, they become much more useful when taken as part of wider context. For example, a red gravestone doji followed after a long uptrend may be a sign that reversals on the cards. So this is an upward trend. What does a gravestone doji mean? Buyers initially pushed the prices high, hence the upward trend, but sellers took back control and drove the prices down, because if it's a red stone, if it's a red, the red, it opens at that bit there, it opened here, and the prices kept climbing, and then it closes here, which is at its lowest. So the prices fell. Hence the downward trend. Let's take a look at what might happen within a 4-hour gravestone doji to see how. And then nothing. Right, okay. Initially in the session, the rally continued, which is here. Can see a general upward trend. But then sellers took over, driving the price down back to the open. If the sentiment continues, then it might be a good time for a short trade. Initially in the session, the rally continues, going up here, but then sellers took over, driving prices back down to the open. If that sentiment occurs, they might be a good idea for a short trade. Doji. So this is another doji here, isn't it? Wait, doji followed by a bearish reversal. So it goes up, 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 and then this is what we talked about here. It went down, 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 followed by bullish reversal, and then Dragonfly Doji, sellers drove the markets down, but buyers to control bought it back up again, and it goes boom, 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 boom. Surely this one should be red though, right? So that it goes down, because the green one, yeah, surely that should be red. Or am I wrong? I don't know, I think, yeah, it probably should be red because that's what they mentioned here, but I guess I'm wrong. Right, anyways, wide-ranging bar. A wide-ranging bar looks exactly like it sounds, a long bar that is at least 2 to 3 times longer than the sticks that surround it on the chart. So, wide-ranging bar. Which is, whoops, there's something on my mouse. Okay, a long bar. Two to 3 times longer than the sticks that surround it. Copy. Wide-ranging bar signals strong momentum in the direction of the bar. So direction, which is the color of the bar. So whether it's an up or no, yeah, whether it's a red or green, right? Or whether it's an upward or downwards. So, well, whoops, what have I just done? Wide-ranging signal strong momentum in the direction of the bar. There is overwhelming buying or selling sentiment. Often the result of a major news announcement, although this is not always the case. Trading a wide-ranging bar may seem tempting due to the clear volatility and sentiment, but more often than that, it's a better idea to take a step back. Okay, so high volatility. They can indicate that any pattern present before the wide-ranging bar will no longer hold. Previous support and resistance too can be overridden when sentiment is strong. Hammer. A hammer is a small body, long lower wick, and a small or absent upper wick. Small body, long lower wick, and small or absent upper wick. can be red or green. Forms after a downtrend. Hammers are taken as a sign that a bear trend may be about to reverse. Hammers are a sign that a bear trend may be about to reverse. Hammers can look like any of the sticks below. So let's do that. As well as having the appearance of a hammer, they get their name from how they form. In this formation, the market is hammering out this low before bouncing up again. Like a dragonfly doji, a hammer signifies that a strong selling sentiment was beaten up by buyers before the end of a session. A strong selling sentiment was beaten out by buyers before the end of a session. Strong selling sentiment was beaten up by buyers before the end of a session. Before the end of a session. So the hammer, if it's a green one, that means it's upward movement. So green one high is at the very top one. It's opened here, it closes at the top, and that's the lowest position. So opened here, dropped to low, but then it closes at its high. Pay attention to the length of the lower wick when looking for hammers. Attention to the length of the lower wick when looking for hammers, as it can tell you about the strength of the formation. As it can tell you about the strength of the formation. Ideally, the wick should be 2 or 3 times longer than the body. Two or three times. Hammer. That's a what's it called? The wide one, isn't it? The wide ranging bar. That's it. The wide ranging bar one here. We've got a, let's say not the dragonfly. That's a gravestone, isn't it? The gravestone doji. Kinda, yeah, gravestone. No, well, not really, because it doesn't have. It has a little lower wick. That's a gravestone doji. That is. Yep. But what if a hammer appears at the end of a bull run instead of a bear one? This is also a reverse pattern, but in this case it signals up potentially the end of uptrend and isn't called a hammer, it's called a hanging man. In a hanging man, sellers took over during the session to postpone a rally. Buyers then pushed the price back up but weren't able to send it much past the open, which means buying sentiment may no longer be strong enough to sustain the uptrend. Did you know there are a few other single session patterns that can be useful? Spinning tops, for instance, are similar to long-legged doji, but with a little bit more width on their body. Marubozu, on the other hand, are all body with no wicks whatsoever. Hanging man. Appears at the end of a bull run, i.e. a bull goes upwards at the end of an upward trend instead of a bear one. Hanging man. And yeah, they're called a hammer. It's called a hanging man. Right, okay. Inverted hammer and shooting star. You can also look for upside down or inverted hammers. These are called reversal patterns. These are also reversal patterns appearing at the end of bear runs and signaling a potential end to the downtrend. If an inverted hammer appears after rally, it is known as a shooting star. Again, it is often taken as a sign that the uptrend may be nearing its end. Right, okay. Wide-ranging bars, hammer. Right, okay. Hanging man. So the reversal. It's not called a hanger, but called a hanging man. So if it's green, then that's a hanging man. Right, okay. Hammer. Let's call it hammer slash hanging man. No, a hammer is only like that. A hanging man would be look different, wouldn't it? Hanging man would be look like green. Right, okay. Hanging man. Appears at the end of a bull run. Because green instead of red. Yeah. Hanging man green uses red. Spinning tops, for instance, are similar to... Right, let's go through this. Inverted hammer and shooting star. You can also look for upside down or inverted hammers. These are also reversal patterns appearing at the end of bear runs and signaling potential end to the downtrend. Similar to hammers. If an inverted hammer appears after a rally, it is known as a shooting star. Shooting star. So... bear runs. So basically the opposite of a inverted hammer is a shooting star. Shooting star equals, what was it? At the end of a rally, so upward trend at the end of a green equals green instead of red. Confirming hammers. It isn't wise to jump into trade the moment you see a hammer. Instead, you want to wait to confirm the move. Isn't wise. Into a trade the moment you see a hammer. Wait to confirm the move. The simplest method of confirming a hammer is to see whether the previous trend continues in the next session. If it does, then the hammer has failed, because the hammer is meant to reverse it, basically. Simplest method. Confirming hammer is to see whether previous trend continues in the next session. If it does, then the hammer has failed. Uh, 49.99. Alright. Shooting star. Yeah, shooting star is green. So green instead of red. Yep, put that right, okay. I think we're gonna leave this here. This is a long one, this is, so yeah. We'll go through the rest of the next video, and yeah, thank you for watching. See you later. Peace.